The following is a presentation of TFNN. Trade what you see with Larry Pesavento. Call now, toll free at 1-877-927-6648 or internationally at 727-445-1044. Now, Larry Pesavento.
Okay, folks, looking good, Billy Ray, feeling good, Lewis. We're going to have Kevin Murphy. He's a friend and disciple of Bill Ehrman of Ehrmanometry on at 9:30. He's going to carry the torch for Mr. Ehrman, who passed away a few months ago, but he has some really wonderful stuff. If you like geometry and technical analysis, you're going to see firsthand the type of thing that Mr. Ehrman did. Okay, let's get on to the job at hand. That is where we're going to go from here. Folks, I've posted the chart in here from 1987. The reason why I did that is for two reasons. One is that you'll see that when we bottomed on September the 26th, which was a solar eclipse, we rallied up into October into the lunar eclipse. And as you can see, after that lunar eclipse, the market just dropped like a rock. You'll notice that we were looking at around 2,500 in the Dow. The Dow had made a high at 2825 on August the 25th when we had a 5-planet conjunction, all 5 planets in the sign of Leo. So it was really an interesting time. You'll notice it went from 2852, I believe, all the way down on the 19th. The actual bottom was slightly lower on the 20th, and that came in at roughly 1666. 1666 was the exact 61% retracement from the 1982 low. It's just spot on. And of course, from there we went 10 times, or a little more than 10 times. We went up to 18,000 and change. I bring this to your attention because astrology does not work all the time, folks. It's just a tool that you use along with other technical analysis. I believe that the patterns are the thing that make the markets move the way they do. You can put the Fibonacci numbers in with them, and you get a pretty good idea of what's happening in the market, but not all the time. Now, the first one we're going to start out with, of course, is the one that we usually start out with, which is the German DAX, and we want to get that up here in just a second, and it's right here, and then we will have it in here in the den for just a second, and then we'll be going on to this level right here. As you'll notice here, the German DAX has hit the 78% retracement from the August 3rd low. This is a very, very important number, folks, and stop and think. Now, we've had a pretty good run here in stocks, but not very much. If you stop and look at what's really happening in the market, you're going to see a market that is not rallying anywhere near where it should be. If we look here at the New York Stock Exchange Index, and that's what we're going to look at, you'll notice that it has not even made a 382 retracement. We didn't do any of the big move was the move from the 10th of September up into the 12th. That was a perfect 61% retracement. But yesterday we did virtually nothing. I mean, it was a big rally, all based on the start of it. Of course, is the Nasdaq, and the most heavily weighted stock in that group, of course, is Apple. And that's one of the reasons. We're going to look at Apple in just a second, but you'll see what's happening. Now let's just stop chattering here and take a look at the S&P where we stand. All right, yesterday we came down. We made a slightly lower low than the 78% retracement. That came in at 2114. We went down to 2108. And then you'll notice we rallied up. The high yesterday was 2145 and change. That was a perfect 78% retracement from the high on the 13th. It was also a 50% retracement from the high that we had made back on the 8th of September. So this is where we are. We're still pointing down. I believe we have more to go to the downside for a lot of different reasons. If you remember, we had Bill Meridian on of Cycles Research on Wednesday, and he told us that, this is the strongest, this coming week here between the 17th and 24th is the weakest of the whole time. Oh, we got a caller, Brent from California. Brent, are you there?
I am, Larry. How are you today?
I am very good, my friend. What can we talk about today?
It's always a pleasure talking with you.
Me too.
I was hoping that you could take a look at the U.S. dollar. It's making a little bit of a move here, and then if you could also take a look at gold.
Be happy to. We'll just chat as we look at this. But as you can see, the U.S. dollar has been in a really, really tight triangle, bounded perfectly by the Fibonacci numbers. The 5 ratio expansions that we had up here back on July 20th, and then we came down and made higher bottoms, the 135 pattern back on August the 22nd, and that's all we've been doing. If we start getting above the, I don't know where the dollar index is trading right now. I follow the euro, but where's the dollar index trading right now?
I want to say over 95.70.
Yeah, 95.70. Yeah. Doesn't mean very much because all you're doing is you're just making another retracement. The key figure to look at is 96.50. If we get that dollar index above 96.50, then you're going to have, a breakout to the upside. But this 5-planet, boy, Larry, you're really getting into it here. Brent, sorry for that. I've got 1987 on my mind. When we have 5 ratios like we do here in the dollar index, I mean, we have a 618 and a 786 retraction. Retracements. We have a 1.27 and 2 1.618 expansions, all coming in at the exact same price of 97.50. This tells us that the U.S. dollar should be heading down. Even though we're rallying now, it should be going down a lot lower eventually. The only way that'll change is if we get above, 97, and then you've got a chance for huge breakout to the upside. But with those 5 ratios there, one has to think that's what you're looking at. I hope that helps.
Oh, absolutely. I'm getting your newsletter, so I've been watching your charts, and I have seen this one posted before. So no, it's an interesting chart. And if you wouldn't mind taking a look at gold as well, please.
I will be happy to, but let's do it through the eyes of silver because that's been the one that has been the best. But it is in fact actually starting to fail now. If you'll give me a second, I'll put this up and we'll see. We had a beautiful pattern last night that led to a pretty good rally, and then of course it failed. But the numbers in gold I'll relate to you, but you can see the silver chart here. We've broken down below the 135 pattern. So gold is trying to come down to test that old low that we made about 3.5 weeks ago at 1308. And so I wouldn't touch the gold or silver or anything related to precious metals until, early on Monday, because then you've got the eclipse out of the way. We have a lunar eclipse and a full moon at 3:05 p.m. today in New York. So that's what I would do is I would wait for that because it just didn't go anywhere.
Okay, thank you.
Stay with us, Brent. We'll be right back.
Okay, yeah. Okay,
thanks for calling in, my friend.
All right,
bye-bye.
Weekend.
You too.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile based scanner in the industry, powered by the acclaimed TAS TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find the Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, we're back, folks, and I've put the chart of gold in. As you can see, that we have gone down and we've taken out that previous low by quite a bit. You know, the key yesterday is when gold only could rally to the 78% retracement of the previous high. That was a $13 rally, a beautiful Gartley pattern. The market was, it was $1,300 ahead at one time. And folks, when the market gives you a lot, you have to realize that once the equity goes in your favor, a perfect example was yesterday in both gold and crude oil. We had a really nice buy signals, right near the absolute low of the day, 1322 in the gold. It rallied up to 1334. After that, once you've made $1,200, your risk now is, if you had an $8 stop, your risk is now $2,000. Your $8 at your original stop and the $12 that you made. So it doesn't take a rocket science to figure out that you've got to change your stop to reduce your risk. So when you've covered your first part of the risk equation, you have to get out of it. The same thing happened in the you have to get out of part of your position, because we're in the business of making money, not being right or wrong. We have the same thing happening in the crude oil yesterday. We bought crude oil right near the low of the day. And it rallied almost exactly $1,000 a barrel, and then started to come down. So your first profit objective was made there, and from that level, then you can put your stop at break even, and that's what's happened. Now oil has come down and made a new low. I haven't given up on it yet. It's got to get below, 42.50 for me to think that it's totally out of the ballpark here to ever rally again, which it usually will. But what I'm looking at now is I want to show you, this is a shorter term chart of the crude oil. It's an hourly chart, and all I'm going to do is to show you where we are right now, and that is, we got down to this 42.90 level, and anything below that, then you're looking at something really significant because it's going to be breaking the 1.618 numbers, and once it does that, it's really headed down, for a lot lower low, and we're already about 9 pips below that level right now, so you can't really touch that. But here's one. The next one is one that I really like, whatever that means, and I'll show you here. This is the Treasury bond market. Oh dear, hold on just a second. There we go. Now we're okay. Okay, there's your Treasury bond market. This is a hourly chart going back. You'll see we made that quick ABCD. We took out the high of the 14th early this morning, about 2 hours ago, and now we're pulling back. This looks like a really good buy around the 65.12 level. And I'm bearish bonds a long time, but not now. I mean, we've got too much going on here to let you know that it's got a chance to rally. But that's just part of it. If you look at the long-term picture in the Treasury bond, going back over the past several months, you see we're making a normal ABCD pattern, which is a Gartley in the bonds at this 64.18 level, which was the low. And now we should have really strong support at around that 165.10 level. You've got a lot of things to say that this is where it should rally. In a longer term, I'm bearish, but realize we've been down since the 28th of July with just very few little rallies. So this is another example of a market that really wants to, have some type of a rally before it finally, gives up the ghost. That's what it looks like from a technical perspective of watching this. So we'll see. We're also at a really key level here in the euro at this 111.70 level. Here again, you have a market that's come down really sharply here, but we are setting at a 78% retracement from the low on September 1st. And we have several other ratios that are there. But because the market's coming down here, the best way to handle this is to wait a half an hour and make sure to see if this candle is going to stop going down. You don't have to buy the exact bottom to still make money. It's going to be volatile enough that if we get a small rally in the euro, you'll get a little bit of a pullback. So watch this price here that we have at 111.65 in the euro. That's a very, very important price because we have so much. It's a beautiful ABCD pattern there, as you can see on the daily chart. And it's a 78% retracement going back quite a way. So this is going to be an interesting one here in the euro. That fits in with what we have going on in the U.S. dollar. We've had a slight rally in that one. We still have lower tops and higher bottoms. We're in a really tight triangle. But what it's saying is that we're at the apex of that triangle right now, right in with the euro here at 111.70. I believe that this is the same thing we're seeing on the upside with the U.S. dollar. So it's at the moment of truth. Just give it a little bit of time. You don't have to try to catch a falling knife, but it's very, very close in here of a turn if, in fact, we're going to be giving it. We're breaking down now in silver and gold as we expected. I think that, because we have this lunar eclipse today and new moon, that we're probably going to make some type of a bottom here today, but the new moon does not happen until 13:05, and I'm not sure if it's accurate to the exact hour or so. Norm Winsky certainly is, but when it is, that's perfectly. So you got to wait till the close. That's the bottom line of what I'd be looking at. But silver and gold are both breaking down, as is platinum. Platinum was another one that we mentioned that could only rally to a 382 retracement when we were making retracements of 78% in gold and 61% in silver. That's telling us that you want it to go, a great deal lower. In fact, I don't see the market doing very much in these precious metals, at least until Monday. That's what you'd have to look at. So those are the ones. But if you had to put them in order, the things that I'd be looking at today would be the euro and then also the treasury bonds. I think those are the best patterns for a tradable opportunity here, and we'll see if we get that opportunity, but that's what it looks like for me. And the bonds would be number one, the euro would be number two, and that would be the main ones that I would be watching from this level. So Okay, now the next one we wanted to talk about is Apple. That is the one that has everybody in a tizzy because it's had such a tremendous rally, and we'll take a look at it here. This thing is still in a major downtrend. It's beneficially happened, or has been, it's been really helped with the advent of Samsung's iPhone came with a cigarette lighter. Unfortunately, it was the thing that burned the thing up. But you'll notice that the Apple has been in a downtrend ever since May of last year. We've had lower highs and lower lows. It's still in a downtrend. All we're doing now is we're making a 1.618 expansion of the move during August. We're making a perfect 78% retracement of the move till November. So Apple looks like a sale here at the 115.57 level. I think the best thing to do is to wait to see a down day in Apple, and then you'll be able to quantify your stop, because if you sold it in this area, you must risk about 3% of that value, which is $4.50. And I think you probably risk less if you wait till Monday. 877-927-6648. Stay tuned for Kevin Murphy.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters. In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, we're back, folks, and I believe we have Kevin Murphy from Nashville, Tennessee on the line. Kevin, are you there?
Yes, I'm here. Good morning.
Good morning to you. We have your chart 1 put up in the thing. Would you mind telling us your relationship to Bill Ehrman? He was pretty hard to get in touch with a lot, but can you tell us how long you worked with him and a little bit about that?
Sure. I met Bill actually in 1998. Actually, I met him over the phone. He wanted me to review a draft of his book back in 1998. So I was actually working for a commodity firm with a guy named Sam Donaldson, who was a friend of Bill. And he gave me his manuscript to look over to see what I thought of it. And that's when I first met him or learned about him. And then 4 years later, when I was managing a hedge fund, I got more involved with him because my work was similar to his. And then we started talking daily ever since 2002 until he passed away this past May. So,
okay, well, why don't you just tell us a little? Oh, go
ahead.
Why don't we just go into chart? Let's just, since we've got such a short time, why don't we go into chart 1? And what we'll do at the end of the show here, we'll just give a little review of what you might be doing in the future. So here, we'll start with chart 1, and we'll go from there.
Okay. The purpose of this presentation is really to give a high-level overview of what this work is about and to show some market symmetry. Because markets are often symmetrically related. So this presentation touches on that because the current market we're in as well, I think, is symmetrically related. Basically, this chart shows the distance in moves from certain major points in the market since 1962, and this is based on Bill's day count. Bill went through market history and resolve the number of trading days in the market going back to the 1920s. And this is part of his work that says these moves are symmetrically related. In other words, the 1962 low to the 1982 low is 5,077 days, which is the same distance from the 1987 high to the 2007 high. Similarly, the 62 low to the 87 high is the same as the 82 low to the 2007 high. So basically, this chart just simply shows that markets are symmetrical and can be related that way. I also broke down the move from 1982 to 2007 for Elliott waivers. That is what looks to be a 5-wave move. You've got an initial move from 82 to 87 of 1,273 days. Then you have the 87 panic, and then you've got a 3,818-day period from the 87 high to the 2002 low. If you take 1,273 and you multiply it by 3, you get 3,819. So this low was 1 day off of that projection. And then you get the final move to the high back in 2007, which in the Dow and S&P was 1,259 days. Now, 1,259 is obviously shorter than 1,273, but this is where the markets get tricky because the market uses different indices to resolve relationships. Sometimes the Dow and the S&P top at different times. Sometimes the NASDAQ tops at a different time than the Dow or S&P, and all those moves are interrelated. And back in 2007, the NASDAQ peaked on October 31st, 14 days after the Dow and the S&P. So if you had 14 days to that 1259, you also get 1273. So considering all the indices, the moves were the first move from 82 to 87 and the last move from 2002 to 2007 were equal, and you had a completed advance. Just to show you how market moves can be symmetrically related. That's the point of this chart. And it's kind of just a broad overview to talk about history and how Bill or I look at the markets and market history. Okay?
In chart number 2, you're looking at more of a Pythagorean theorem thing, aren't you, where you're looking at this thing in relationship to a circle and the squaring of the circle type thing?
Yes, this is Bill's chart. This is called the golden mean template. Now, Bill never displayed this on his website, but this is what it looks like. Did you get a chance to update the new chart 2 I sent you about an hour ago?
Yes, I did, and if you'll give me a second, I'll get that up here.
Okay.
I only have it right here. Well, should be okay. Yeah, here it comes. We'll get it ready, and we'll be here in about 2 seconds. I thought I did that, but there we go. There's the updated.
I just put some labels on it, A, B, C, and D. I just put some labels on the segments of the template.
It's up there. Go ahead.
Okay. The whole heart of Fibonacci and golden mean mathematics is what's called the 1-2 triangle, which shown in this template as the triangle ABD, which has a side of 2, a base of 1, and a hypotenuse of 2.236, which is the square root of 5. So that is the basis for this template. What Bill did is he took a right angle at point A at the top of the chart, and he created symmetrical triangles, or similar right triangles, ADC and ABC, that are all similar in proportion to ABD. And then from there, he started branching out, creating other segments shown here. And this is basically his model for how market moves are related to each other. And the next chart, chart 3, will show you an example of how this works. So if we'll jump to chart 3, this is an example of how to use the template. And what the template shows, and I've labeled the segments of the template here, is that market moves are related by distances on the template. So if you took the distance from, say, the 1929 high to the 1973 high, which is segment A, and you placed it on segment AC of the template, then you have the distance from the 1929 high to the 1987 low on segment XC. Okay? This is what's known as a contiguous move. In other words, they begin at the same point, but they end at different points. Obviously, you might have another distance in another segment, say, from another point in time, say the 62 low to the 87 high or the 2007 high. Those are called non-contiguous segments, and you'll see a lot of those as you move distances around the template. You see a lot of interrelationships in the market. But this is the basic method that Bill used to determine whether market moves are significant or interrelated. What I've done since then, Bill did everything by hand. What I've done since then is incorporate everything into spreadsheets and programs so I can look at any particular day in history and see what market relationships are related to those days throughout history. So,
are you using a computer at all, Kevin, to do this, or is it?
Absolutely. Okay. I'm using a lot of computer horsepower to process this data so I can see things very quickly where before
stay with us. Yeah, stay with us, Kevin. We've got to take a little break here, and then we'll be right back. Give us 3 minutes, okay? We've got to pay some bills.
Sure.
Thank you very much.
Yep.
If you're looking to discover a new financial resource and diversify your financial portfolio, consider the new market-safe focused commodity CD from Everbank. This 5-year U.S. dollar-denominated CD gives you exposure to 6 equally weighted commodities, including gold, silver, copper, nickel, soybeans, and sugar, in one powerful CD. With annual pricing caps of 50% per component, you could earn up to a 50% upside payment at maturity if the commodities increase in value across annual pricing dates. And should the opposite occur, your principal is 100% protected. Keep in mind, returns are based on CD performance. There is no annual percentage yield or periodic rate of interest on this index CD. Don't miss out. Take advantage of this financial resource designed to grow with the times. The October 13th funding deadline will be here before you know it. So hurry over to everbank.com/TFNN for the CD's term sheet and other important product details and disclosures. Once again, that's everbank.com/TFNN. This advertisement is sponsored content. Everbank is a member FDIC. It's 2016 and TFNN has a brand new programming lineup to kick things off. Starting January 4th, swim lessons by Thinkorswim and TD Ameritrade will be airing 5 days a week at noon Eastern Time. Join hosts Scott Connor, Kevin Hinks, and Cindy Faber as they host their daily options program live at noon 5 days a week with no commercials for the entire hour. Nico DeHaan and Paige Clark will be moving their program, Living a Primal Lifestyle, to twice a week, Tuesdays and Thursdays from 7 a.m. until 8 a.m. Eastern Time. Wake up with Nico and Paige and start your day off right. The Bull Bear Binary Option Hour by Nadex will now be live Mondays and Fridays at 10 a.m. Start and end the week with the three hosts, Tom O'Brien, Tommy O'Brien, and Daryl Martin, as they break down the world of trading binary options and spreads. For all the details on the new 2016 programming lineup, visit the front page of TFNN.com. TFNN, educating investors. Biotech is booming, but for how long? Whether you think the biotech bull has room to run or has run its course, trade LABU or LABD. Directions Daily S&P Biotech 3 times bull and bear ETFs. Visit directioninvestments.com/biotech today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
The Bull Bear Binary Option Hour, sponsored by Nadex. Up next on TFNN.
Okay, we're back, folks, and we have Kevin Murphy talking about market geometry, and we have chart 4 up for you now. Kevin, you want to go to that one?
Sure. Yes. Here we're talking, this is why I alluded to market symmetry before. Here we have similar moves. You've got the 2000 high to the 2008 low, which is 2,227 days, and then I'm projecting a major low in January of 2018. The method used for that projection is not shown. It's based off the 1929 high and other relationships, and it should be a major market low. So the purpose of this chart is to show some symmetry between moves. And what the market does when it bottoms at separate points in time, like in November 2008, again in March of 2009, is the market typically displaces moves like this. So if you take the distance from the 2000 high to the 2008 low and you add it to the 2009 low, you arrive at the same date as the long-term projection for a major low in January of 2018. What I also noticed a month ago was that the projection from the 2007 high to the high we made last month, the Dow and S&P on August 15th was also 2,228 market days. So here you see some nice symmetry in the markets, and this is what I've seen. This is the way I've seen the markets behave before, which is why I think the Dow and the S&P peaked last month, and we are now in the early stages of a bear market that should last about 17 months.
Wow, that's okay. Let's go on to chart number 5.
Sure. Chart 5 shows some other market moves and how they're related to the low in 2018. In the upper left corner is the 1-2 triangle, the symmetry, the geometry of the 1-2 triangle. That triangle simply shows how the relationships between, say, the 62 low, the 1980 low, and the 2000 high in the Dow were reached. It also shows those previous moves and how they related from previous lows around the year 2000 to the projection in 2018 for a low. So the purpose of the chart is simply to show how the geometry of different moves replicate themselves in the market over time. That's what this chart simply shows.
Well, this goes along with what Andrew Lowe says in his book, that markets repeat. So this is really good stuff.
Thanks. That makes sense.
Does the book that he wrote, I mean, I know he pre-sold some of it, and very few people ever got a copy of it. what is your plans as far as what are you going to do? I know we've talked a little bit on the phone. Have you decided whether you're going to come out with a service or a newsletter or reprint the book? Do you have any idea yet what you're going to do?
I don't. I started a letter last month called the Vitruvian Market Letter. I wrote a special report about why I thought the markets peaked last month, and I sent that out to some of Bill's clients and other potential subscribers to see what their thoughts were. And I'm also writing a special report about the highs. The highs we're putting in now, because apparently this high is also related to the European highs that were put in April of 2015. So I'm really in the process of deciding how I want to do things, but I'm happy to send out the reports to people if they would like to see it and evaluate it and see what kind of value it is to them.
And how would they reach you, Kevin?
Email is kwmurphy, kwmurphy at bellsouth.net. And if they email me, I'll send them the report back last month, as well as the one that I'll produce this coming weekend.
Okay, that's really good. Why don't we?
At this point, there's no plans for a book. I have segments of the book that Bill created, which I'll be happy to send people. But as far as producing or publishing a book, I have no immediate plans at this point.
Yeah, that's a lose-lose proposition because everything is on the internet now, and it's not to do a book is almost nearly impossible. It's a KW Murphy at bellsouth.net, correct?
Yes, that's correct.
Okay, that's great. Do you want to go? Well, what we're going to do here is we got about 3 minutes to go. We'll cover chart 6. And then we'll come back and we'll give a little bit of more of how the folks can reach you and that type of thing. But let's go on to chart 6 now, because this really hits the nail on the head, in my opinion. It shows the importance of the 1982 low, which that was on August the 9th, and that was a huge astrological date. And so fire away, my friend. We'll look at chart number 6 now.
Okay, well, this is interesting because it just showed that the similarity between the 16-year bear market between the 66 Dow high and the 82 low, that 16-year period is also replicated between the 2000 Dow and S&P high, something called a balance point, to the high we put in at the beginning of this month in the NASDAQ index. So you've got symmetry going on here between those two moves each 16 years. You've also got a relationship between what Bill called the major balance point high of the 1970s to the high we put in last month by a golden mean factor of 1.1708, which is also related to the golden mean triangle. So again, this is where it gets a little bit complicated, but the ratios do show up when you balance everything out in the golden mean template.
And this is all related to time, isn't it? It has nothing to do with price, correct?
That's correct. This is all time related. What I did is I also went to calendar day time and showed how these relationships also tie into calendar day time as well as market trading day time. What interested me was the fact that the 2009 low was exactly 4,000 weeks from the 1932 low. So I went back through history, back into the 1800s, and showed how long-term market relationships were also tied together in terms of calendar days as well as trading days. So there's a lot to this, but this kind of summarizes a bit about how it works.
Well, it's certainly a very complex subject, and he approached it differently because he only looked at time. Just about everybody else was looking at time and price together, but he only did time. And I knew that he had never traded before. He just spent his life's work, learning this stuff. So I think if you grab hold of this, you've got something really good. I mean, this is the first time I've really heard you give me a description of it, but this is exactly the type of thing that, people could use and need because it's long-term related. And also, pretty well that's within 1 or 2 days. So if it's not working, that you just move on to the next level. Is that correct?
Yeah, that's correct. The predictions are at most a day off. So within a very short window of time whether you're right or not. And you can certainly wait for the markets to react based on the projections to see if they behave like you wish them to or expect them to. And if they don't, you'll penetrate that point in time and move on to the next one. At least that's the way Bill approached it, and that makes a lot of sense.
It made sense to me because I followed him for about 7 years, and it would amaze me that, he would have a perfect day, and then, we were in such a bull market that it would last for 2 or 3 days, and then it would keep going higher. And he said that, once it goes higher, it's going to go a lot higher. So that in itself was a telltale signal that you want to be on the right side of the market. We got to take a break. Stay with us, Kevin. We'll wrap it up in a few minutes, okay?
Yep, thank you.
Thank you.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to the Gold Report, an $85 value, visit the front page of TFNN.com today.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, we're back, folks, and we're talking with Kevin Murphy on market geometry, some of the work that Bill Ehrman from Ehrmanometry worked on that I was very impressed with, and I'll tell you, it's about as good as stuff as I've seen in the 55 years I've been in the business, and mainly because it's related to time. Kevin, your email now, or your email address is kwmurphy, and that's at bellsouth.net. Is that correct?
Yes, sir, that's correct.
Okay, now we've chatted on the phone a few times. Now, if a person has a question or something they would like to chat with you, I think the best way for them would be to email you, and then if you decide that's what you'd want to do, you'd let them know your phone number, and they could go from, and you can answer some questions from that level.
Yep, that's correct.
Okay, that's good. One other thing I wanted to mention, Kevin, if you do decide to bring this out commercially, and charge a subscription, I wish you would let me know. We'll have you back on. And also, if you want to be on to talk about a specific date that's coming up into the future, I know you mentioned January of 2018, and believe me, everybody in the Tiger Den has a memory like an elephant, so they're going to be writing that down. But if something comes up that you'd really like to share with us, just drop me a line and we'll get you on the show, to let the folks see what you're doing. Because this is unusual work, folks. This is the work from Pythagoras, how it relates to the market and Fibonacci summation sequences. And it's all related to time. It's just time. It has nothing to do with the price. We can use patterns to tell us where we are with the price, but the time is the real key. Did you want to finish up with anything right here?
No, you made some very good points. This is extremely sophisticated and complicated. I mean, I've been in markets myself for about 30 years, and this is the most advanced method I've ever seen for analyzing, markets history and market movements. Again, it is quite sophisticated and complicated, but it's the closest thing I've seen to be able to forecast market behavior. So.
Well, it's certainly.
Thanks for your time and comments. I appreciate those. And
thank you, Kevin. We'll have you on again soon, my friend. And may God bless.
Okay. Thank you. Bye-bye.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.